On July 13th, 2024, the world-shattering assassination of Trump took place. In the end, Trump had a scare and dodged the bullet. But what's even more shocking is that someone predicted this event ahead of time. Viewers noticed that in a YouTube video from March 14th, 2024, a man named Brandon Biggs, a Christian pastor, accurately described some of the future scenarios he saw with his celestial eyes, and his description of Trump's assassination was exactly the same as what actually happened 4 months later. The accuracy of this prophecy is unbelievable, and what he describes later in the program is even more remarkable. He saw a huge financial crisis coming with the election of Trump, worse than the Great Depression. This is strikingly similar to what I've seen in the last couple of years from some of the biggest names in the investment world warning about the current economy. Nouriel Roubini, the economist who accurately predicted the 2008 financial crisis, was asked by a reporter whether the 2008 financial crisis would return. Roubini's answer was, "Yes, we are here again." Michael Burry, who made a fortune by shorting subprime mortgages during the 2008 crisis, has been warning since 2021 that the next crisis could be the worst one yet. The founder of the Bridgewater Fund, Ray Dalio, also said that we are entering a depression similar to that of the 1930s, and that the recession will turn people's lives upside down. I started feeling uneasy. Could another Great Depression really be on the horizon? I decided to dig deeper into history. How did the worst economic depression of the 20th century actually come about? And what parallels exist between then and now? Let's return to the 1920s and see what the United States looked like back then. At that time, World War I had just come to an end, and the United States had jumped from a pre-war debtor nation to the world's largest creditor nation, holding 40% of the world's gold. By 1920, America's electricity production was equal to Europe's total output. It produced over half of the world's steel and 2/3 of its oil. In 1913, Ford developed the world's first automobile assembly line and put it into production. The increase in production efficiency and the drastic reduction in costs brought the automobile, originally a luxury item for the rich and powerful, into the homes of ordinary people. However, the United States was still mostly poor. A car could cost a worker several months of wages. Many people could not afford to buy one. To stimulate spending, banks offered low-interest loans. There were no credit cards at the time, and the most common way was installment payment. Basically, you could pay for everything in installments, such as a house, car, or radio. Due to the lack of a credit rating system and adequate supervision, no matter who you were, you could easily get money from the bank. Overconsumption and conspicuous spending became the main trends, immersing people in the glittering illusion of prosperity. This era became known as the Roaring Twenties. While the public went on spending sprees, capitalists made enormous profits. Borrowing to buy consumer goods was one thing, but the situation turned dangerous when people began borrowing to invest in stocks. Economic growth propelled an 8-year bull market. The Dow Jones Index soared from 67 points in August 1921 to 380 points in August 1929, an increase of 567%. This unprecedented bull market attracted scores of retail investors, from business tycoons to street vendors, and even shoe shiners and newspaper boys. Those without cash borrowed to invest, while the wealthy used even more leverage. Banks also became deeply involved in stock investments, eagerly lending money to anyone planning to buy stocks. Investors could secure a 10 times leverage on stocks, and big players even went up to 25 times. Greed overpowered reason, and investors paid little attention to companies' fundamentals, only interested in selling their shares at a higher price. The stock market had become a legalized casino. Beneath the facade of prosperity, however, signs of crisis were emerging. Income inequality had grown more pronounced, with wealth increasingly concentrated among the upper echelons of society. According to historians, from 1925 to 1928, American factory production grew by 55%, but wages increased by only 2%. During this period, the wealthiest 1% controlled over 40% of U.S. wealth, while the bottom 40 to 50% of the population accumulated little wealth and often carried debt. Such extreme inequality led to a weakened consumer base, with various sectors experiencing declining sales and overproduction. By the spring of 1929, the Federal Reserve grew concerned about the surging stock prices and began tightening monetary policy. Interest rates climbed from 1.5% in February to 6% by August, indicating firm intervention. Astute brokers, sensing a shift, raised margin requirements. This shocked investors out of their frenzy, jolting them into the realization that leveraged stock purchases could lead to massive losses. On October 21st, a wave of sell-offs hit the New York Stock Exchange at the opening bell. Then followed Black Thursday, October 24th, Black Monday, October 28th, and Black Tuesday, October 29th. Stock prices were like dams bursting. The market was in unprecedented panic, with everyone selling their stocks at any cost. This stock market crash also started the 10-year-long Great Depression that spread from the United States to the rest of the world. By June 1932, the Dow Jones Index had fallen to 42 points, wiping out 90% of market value in just 3 years. Countless investors lost their life savings, and thousands committed suicide. Worst of all, depositors rushed to withdraw their money, triggering bank runs. Many banks had also invested in the stock and housing markets, and as asset values plummeted, they couldn't repay depositors, leading to waves of bankruptcies. The first major bank to collapse was the Bank of the United States, which had 400,000 customers. Without an FDIC or similar insurance, bank failures meant that people's deposits could vanish forever. Bank failures sparked a domino effect, eroding public confidence in banks nationwide. From 1929 to 1933, 9,000 U.S. banks failed, erasing $140 billion in deposits, equivalent to $3.4 trillion today. With banks failing, the crisis of overproduction spread across all industries. Companies went bankrupt, and by 1933, the U.S. unemployment rate soared to 24.9%, leaving 1 in 4 people without income. Due to close economic ties between the U.S. and Europe, America's depression quickly spread globally. Economists still debate the root causes of the Great Depression. However, overconsumption and a false sense of prosperity, excessive speculation, income inequality, and flawed monetary policy are widely acknowledged as contributing factors. Are we, as Rubini said, back here again? Consider our current consumption habits. While cars symbolized the spread of consumerism in the 1920s, today's globalization and technology have pushed consumer culture to an extreme. The rise of credit cards means people no longer need to visit a bank. An online form will do. The internet has removed geographical barriers to purchasing, and anything from the world's farthest reaches is just a click away. Social media encourages constant comparison, prompting people to pursue luxury cars, mansions, designer watches, and bags, equating these symbols with success and happiness. Excessive consumption has led to mounting debt. Today, people rely on credit cards, mortgages, car loans, and student loans to maintain their lifestyle, while corporations borrow to expand or buy back stock, and governments run deficits. U.S. household, corporate, and government debt levels are at record highs. As of Q2 2024, U.S. national debt reached $35 trillion, exceeding 121.6% of GDP. Historically, a debt-to-GDP ratio over 77% correlates with slower economic growth. According to the latest Household Debt and Credit Report, total U.S. household debt reached $17.8 trillion in Q2 2024, including $12.52 trillion in mortgages, $1.63 trillion in auto loans, and $1.14 trillion in credit card balances. Excessive debt can stifle long-term growth and trigger a financial crisis. Stock market speculation is another red flag. The US market has seen a prolonged bull run, particularly in tech and high-growth sectors like AI, which resembles the speculative fervor of the 1920s. Famed investor Michael Burry has expressed concerns over the ETF market bubble, warning that reliance on a few key stocks is dangerously distorting the market. In the first half of 2024, Warren Buffett dramatically reduced his holdings in Apple, bringing Berkshire Hathaway's cash reserves to $276.9 billion. Buffett stated that an economic crisis is just a matter of time, and Berkshire's substantial cash reserves are to prepare for such an event. Income inequality has worsened compared to the 1920s. According to Federal Reserve data, the wealthiest 1% held 34.9% of U.S. wealth as of 2021, comparable to the 40% share of the 1920s. Meanwhile, the bottom 50% of the population collectively held less than 2.5% of national wealth. During the 2020 pandemic, U.S. billionaires' wealth grew by $1.3 trillion, while many lower-income families depended on government aid. Today, however, most countries have systems in place to manage economic crises. The Federal Reserve has flexible monetary tools like interest rate adjustments and quantitative easing, as demonstrated during the 2008 financial crisis and the 2020 pandemic. The U.S. also has a robust regulatory framework to prevent bank failures and excessive market speculation, such as the Dodd-Frank Act, which introduced stricter capital requirements and limited high-risk investments. What I want to say is that people need not be overly pessimistic. Every Great Depression is a reshuffling of cards and a redistribution of wealth in society. The prophet mentioned at the beginning, Reverend Brandon, describes the scene he saw as a good time, a green time, coming after the financial crisis. Therefore, be well prepared for the next crisis, which may be a crisis for others, but an opportunity for you. What do you think about the current economic situation? Do you think the Great Depression will return? Please express your views in the comments section. Thanks for watching.
Since the crash of 1987.
The Dow traders are standing there watching in amazement. I don't blame them.
We're now down 43%.